What should you have prioritized in your 20s? Have you ever considered whether there are smarter ways to manage your finances? Do you ever find yourself struggling financially or about to run out of money? Imagine if I told you that there are practical actions you can take right now, even with little means, to set the groundwork for a secure and wealthy future. Your 20s are frequently regarded as a critical period in your life, and if you ask folks in their 40s and 50s, they will most likely tell you that they wish they had started investing earlier and made more wise financial decisions. While you've certainly received some advice on saving and investing, it's critical to learn where and how to invest wisely while you're younger. In this video, we will answer this question and present information on 6 potential investing options to explore. You may not be able to explore all of them, but we recommend carefully evaluating each one and choosing at least the first 2 that we believe are vital. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. First, invest in S&P 500 index funds. Putting your money into growth-oriented assets can significantly accelerate your wealth accumulation, especially if you are young. These funds use compounding interest to create returns faster than most other investing options. The S&P 500 index, with its track record, stands out as one of the most secure and lucrative investing options. To illustrate, if you invest $10,000 in certificates of deposit, generating a 2% annual return at the age of 25, and aim to retire at 65, your retirement fund would be $20,000. However, if you invested the same $10,000 in S&P 500 index funds with a 10% annual return, your retirement nest egg would grow to $400,000. This represents an astounding 20-fold increase over the CD option. It is critical to understand that the 10% average return on S&P funds is an aggregate statistic based on previous decades' performance. Rates might fluctuate significantly, with a 20% loss one year and a 40% gain the following year. However, when you are young, you can afford to take this kind of risk. Number 2, create a retirement plan. This is an absolute requirement. Starting early allows you to start saving for retirement and take advantage of compound interest's powerful benefits. Even a one-year gap in your retirement savings might result in significant differences, perhaps amounting to thousands of dollars. So if you haven't already, start this procedure immediately. For example, if you begin contributing $500 per month to a retirement plan with a 7% return at the age of 25, you may expect to have approximately $2 million when you retire. However, if you ignore this advice and postpone for a decade, beginning at age 35 with $1,000 monthly payments to a retirement plan with a 7% return, you will most certainly end up with around $1.6 million in retirement. This is a 20% cut while donating 50% more yearly. The example above clearly shows that the earlier you begin, the more your money benefits from compound interest and its cumulative effect over time. Time is your most valuable possession. Starting early is critical for building your retirement funds. It is not only about the first investment. You can start with a small sum, such as $100, and gradually grow it. However, starting with a larger sum is also advantageous. While the initial investment is important, especially when considering compound interest, time is your ultimate ally. As previously established, the earlier you start, the greater your rewards will be. Another compelling reason to adopt a retirement plan is the tax deferral benefits it provides. Who wouldn't want to reduce their tax liability? The benefits of tax deferral are similarly significant. However, suppose for whatever reason you decide to invest the same amount as previously specified, say $500 per month, but this time in a taxable investment avenue with a 25% tax marginal rate. In such instance, your returns would drop to 5.25%. As a result, instead of the almost $2 million you may have amassed with a retirement plan, you would receive approximately $1.3 million, indicating a 35% loss. The most commendable retirement plans include 401k or 403 alternatives for employees, as well as standard or Roth IRA plans for people who do not have employer-sponsored coverage. Number 3, invest in real estate investment trusts. These trusts are another type of growth-oriented investment that should not be disregarded in your 20s, especially if you do not yet have the financial means to invest in physical real estate or own property. REITs present a great opportunity for wealth building. When you invest in a real estate investment trust, you receive access to a diverse portfolio of commercial real estate assets. This strategy has distinct advantages over owning a single real estate unit because your investment is dispersed across multiple properties in different countries, increasing the overall security of your asset. Furthermore, the barrier to entry is substantially lower than acquiring a single home. A few $1,000s can get you started, a far cry from the enormous money required to purchase an individual unit, which may typically cost 5 or 6 figures or more. Additionally, REIT investments do not require active management on your side. Another major advantage is that this investment strategy allows you to participate in the commercial real estate market, which typically outperforms residential properties. If you are still unsure about investing in REITs, consider 2 essential factors. For starters, real estate has regularly proven to be one of the best performing assets over the last 50 years. Second, real estate markets frequently operate independently of the stock market, allowing REITs to deliver continuous positive returns even during periods of stock market depression. Number 4, robo-advisors. If you've been watching this video, you've probably noticed our recommendations for real estate investments, equities through REITs, and S&P 500 index funds. While these are fantastic financial alternatives, you may be apprehensive to manage them on your own. In such circumstances, robo-advisors can be a significant asset. Robo-advisors are online, automated financial platforms that make all investment choices on your behalf. This includes developing a tailored portfolio and managing it proactively in the future. It may sound unorthodox, but let's be realistic. Not everyone has Warren Buffett's investment skills. You may not have all of the knowledge needed to make the best investing decisions, which is where robo-advisors come in. These automated platforms not only reinvest dividends on a regular basis, but also keep your portfolio balanced. They also offer specialist advice on tax techniques to help you reduce your taxable investment income to the fullest degree possible. All you have to do is fund your account, and the automatic systems will take care of the rest. It's a hands-off approach to investing at its best. Typically, these automated platforms spread your assets among bonds and equities, and may even include REITs, resulting in an ideal portfolio. Number 5, purchase a home. Owning your own house provides a particular sense of security and stability. Owning your own home is a common goal and a significant financial expenditure. Beyond providing you with peace of mind, stability, and a place to call home as you enter your golden years, owning a home allows you to build significant equity over time. Furthermore, homeownership provides financial leverage because you can purchase a home with down payments as low as 5% or, in certain cases, none. This implies you might benefit from property appreciation on a $300,000 home with an initial investment as low as $15,000. Even if you merely pay off your mortgage over a 30-year period, your property's value is likely to increase, exceeding the initial $300,000 due to the natural appreciation of real estate. Nonetheless, while the benefits of owning a home are numerous, buying one at a young age presents some obstacles. In your youth, you may not be able to commit to a specific geographic place, and your work may need relocations. However, in such cases, you can always rent out your property or use sites like Airbnb to earn money. Acquiring a home is a major financial decision, so it's critical to be confident before making the jump. Number 6, invest in yourself. Investing in oneself, while frequently ignored, is just as important. After all, what's the point of having a car with a faulty engine? Investing in oneself entails addressing all facets of your well-being. This covers both your mental and physical wellness. Invest in comprehensive healthcare coverage and lead a healthy lifestyle. Furthermore, keep enrolling in courses to expand your knowledge and skills because, let's be honest, studying might become more difficult as you age. Seize the opportunity of youth to improve your education, seek master's and MBA degrees, or even a PhD, and take professional courses in your chosen career path. This not only improves your skills, but it also leads to higher-paying work opportunities or prepares you to handle your firm more successfully, especially if you are an entrepreneur. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?